If I handed you a crisp 100 bill right now and said, you can't spend it, you must make it grow, what's your first move? Not your dream move, not when I have more money. I mean today, with $100 in the same brain you woke up with. Would you protect it, multiply it, risk it? Or would you freeze, scroll, and promise yourself you'll figure it out tomorrow? Be honest, because your answer to that tiny question is the blueprint for the next 10 years of your financial life. Here's the uncomfortable truth no one prints on a classroom poster. The system is not going to sit you down and teach you how to go from 100 to 1,000 to 10,000 to 100,000. School teaches you how to be careful with money you don't yet have. The world rewards people who learn how to make money behave. That skill is learnable, and we're going to learn it together right now. I'm going to walk you through a clean path from 100 to something meaningfully bigger, stepping through options from the sleep at night safe to the white-knuckle wild. The risk rises as we go. The potential reward rises with it. Along the way, I'll give you simple rules, tiny experiments, and a 30-day practice that turns this from interesting video into new habit. I'm not your financial advisor. I'm the professor who refuses to let you zone out. I'll give you the why, the how, and the guardrails, so you keep your curiosity high and your tuition paid to the market as low as possible. One promise before we begin: I will never tell you to gamble disguised as investing. I will show you where to put $100 to learn, to protect, and to grow. And I will ask you to decide in the next 7 minutes what your first move will be. Deal? Good. Let's go. Start with this mental model. There are only 3 jobs your first 100 can do for you. It can be a buffer that prevents disasters from becoming debt. It can be a builder that compounds quietly. Or it can be a bet that might sprint or stumble. The worst thing you can do at the start is confuse a bet with a builder or a builder with a buffer. Sort the dollars. Give each job one clear mission. After that, money gets a lot less mysterious. Your first assignment is boring, and boredom is the point. Park a chunk of that 100 in a high-yield savings account and start your emergency fund. Yes, I know high yield can sound like low excitement. Yes, interest rates rise and fall and never feel like fireworks, but this bucket is not about returns. It's about removing the single biggest wealth killer in most people's lives: panic debt. When you have no cash cushion, a flat tire becomes a credit card balance. A broken laptop becomes a payday loan. A surprise bill turns you into a forced seller of your best assets at the worst possible moment. A small emergency fund is a shock absorber. It's the difference between annoying expense and financial spiral. How big should that buffer be? If you're just beginning, aim for a few hundred to a few $1,000s as your first milestone. That's 1 to 3 small emergencies. You can build it with 20 here, 10 there, 100 when you have it. You do not need the perfect account to begin. You do need instant access, 0 fees, and the ability to automate tiny deposits. If your bank offers 3 today and 5 tomorrow, fine. Don't get cute. The interest is a side dish. The main course is resilience. Buffers beat bravado. They also buy you courage. It's easier to take smart risks when you know one wrong week won't wreck you. Quick checkpoint. If your buffer is 0, your first 100 goes here. I know that isn't sexy. It is powerful. Nothing compounds like the relief of not making emergency decisions in a panic. Now, what about a hedge, something that tends to hold value as currencies wobble and headlines shriek? Enter gold. People call it a safe haven. It's been a store of value across centuries and systems because you can't print more of it by pressing a button. But understand what gold is and is not. Gold is a protector, not a pay raise. It's a long-term defense against inflation and chaos. It's not a machine that grows your 100 into 1,000 quickly. There's also an invisible cost called opportunity cost. While your gold holds its ground, the rest of your capital could have been out there working up a sweat in higher yield assets. That trade-off is the real risk in a hedge. If you want a slice, keep it small at the beginning. You can buy a tiny amount of physical gold, but remember, premiums on coins and jewelry mean you'll pay more than melt value. You can buy gold exposure through an exchange-traded fund in most brokerage apps, which gives you liquidity without a safe at home. If you're asking, should my first 100 go to gold? Not unless your buffer is set and your growth engine is already humming. But a thin slice as a long-view defense? Reasonable. Now we get to the builder that quietly changes lives, broad market index funds. If I had to teach a teenager one wealth tool with a single weekend, this is it. An index fund is a basket that holds hundreds of leading companies at once. When you buy the basket, you own slivers of those businesses in proportion to their size. You don't have to guess which single company will win. You ride the performance of the entire market segment. Why do I love this for beginners? Because it turns a dangerous question, which stock will moon, into a productive habit. How do I consistently buy the market and let compounding do its job? Over long stretches, diversified equity markets have returned roughly 7 to 10 annually before fees. That doesn't mean straight lines. It means a staircase built of squiggly steps, sometimes up 2, down 1, sideways 3. But if you train yourself to buy regularly and ignore the noise, the math starts bending in your favor. Skip the hype cycles. Buy the whole forest. Here's a small but mighty upgrade. In many countries, you can hold your index funds inside a tax-advantaged wrapper. In the U.S., that might be a Roth IRA. In the U.K., an ISA. Names differ by country, but the principle is the same. You contribute with after-tax money, and your future gains grow sheltered. When your investments aren't constantly picked at by taxes, compounding gets to flex. There are annual contribution limits. There are rules. But if you're eligible, this wrapper is like putting your investments in a glass case labeled "Do Not Touch." I would rather own a simple market index inside a wrapper than a flashy pick in a taxable account. Boring is brave. But 100 won't buy a whole share of a big-name fund. You don't need whole shares. Many brokerages offer fractional shares now. $10 buys you $10 worth. Start. Automate. Even $5 a week matters because it trains the muscle that turns paychecks into assets without willpower. Willpower is a terrible system. Automation is discipline you set once and keep forever. Maybe you like real estate. You love the idea of rent showing up while you sleep, but you don't have a down payment or a desire to fix a leaky roof at 3 a.m. Meet REITs, or real estate investment trusts. Imagine thousands of investors pooling money to buy income-producing properties, apartments, warehouses, medical offices, data centers, and sharing the rental income. That's a REIT in practice. It's a way to get exposure to property markets without becoming a landlord. A few useful notes. Many REITs are required to distribute a large portion of their profits to shareholders, which means dividends hit your account regularly. The flip side is that REITs can be more sensitive to interest rates and economic cycles. When money is cheap, property flies. When rates rise, valuations can compress. With 100, you can buy a small slice of a REIT index fund or an individual REIT, often through fractional shares. You'll learn how real estate cycles feel without owning a roof. If you want to diversify beyond pure equities and into tangible cash-flowing assets, a modest allocation here can make sense. Let's step sideways into something more hands-on. Buying and selling items for a profit. This is not Wall Street. It's everyday arbitrage. Find undervalued items in the wild, list them where demand is stronger, and pocket the spread. The risk here isn't market volatility. It's your judgment. If you know a niche retro electronics, gaming consoles, vintage clothing, textbooks, camera lenses, RC model gear, golf clubs, collectible cards, you have an edge. You can spot a gem in a dimly lit photo on a marketplace. You can authenticate, clean, photograph properly, and tell the story that helps a buyer feel confident. Why include this in an Invest 100 masterclass? Because flipping teaches you 3 skills the market won't: pricing reality, negotiation, and operational discipline. Here's a mini playbook you can run with $100. Pick a niche you actually care about, so research doesn't feel like homework. Search local marketplaces and garage sales for listings with vague titles and blurry photo signals of underpricing. When you message the seller, be kind, be fast, and ask 1 or 2 clarifying questions. If the item is as described, negotiate respectfully. Small discounts matter when margins are thin. At home, clean the item as if you were the buyer. Take sharp photos in daylight. Write a description that answers the questions you'd ask. List on a platform where the audience values what you have. Pack like a pro. Track your costs. The risk is inventory that doesn't move. Limit that risk by buying only what you'd be comfortable holding a while or what you can return. Here's what starts to happen after a few cycles. Your 100 turns into 120, then 150, then 200. You begin to see patterns. You stop overpaying. You decide if you love the hunt or prefer the hands-off. Either way, you walk away with a more valuable brain. Making 100 work isn't about memorizing ticker symbols. It's about learning how value hides and how to coax it into the open. Now let's talk about individual stocks, where risk and reward begin to swing wider. This is where too many beginners confuse good stories with good businesses. If you want to learn by picking a stock with 100, here's how you give yourself a fair shot without pretending you're inventing a new algorithm. Start with your circle of competence, businesses you understand as a customer. Write a 1-paragraph thesis in plain language: what the company sells, how it makes money, why you think the next 5 years will be kinder to it than the last, and what would make you admit you were wrong. If you can't do that, you're guessing. Use basic fundamentals. Does the company produce real cash or just clever metrics? Does it have a moat, something that makes it hard to copy? Is management aligned with shareholders? Is debt reasonable? You do not need to be an accountant to ask these questions. You do need to be honest. Then size your bet like a scientist, not a gambler. With 100, that might mean you buy 50 of a company you believe in and keep 50 for your builder or buffer. You learn how it feels when the price swings. You practice not chasing green candles or panic selling red ones. There's a famous idea that a blindfolded monkey throwing darts could beat the experts some years. The point is not that experts are useless. It's that markets embed a lot of information, and outsmarting everyone all at once is rare. So if you dabble, do it to learn behavior, not to prove brilliance. Keep a simple journal. Date, what I bought, why, price, what would change my mind. In 6 months, read your own words. Your past self will teach your present self where you were fuzzy. That one habit can save you thousands over a lifetime. Ready for the frontier? Cryptocurrency lives at the edge where innovation meets volatility. Bitcoin, Ethereum, and a long tail of other projects have created a new asset class with properties you won't find in traditional finance: programmable money, decentralized networks, digital scarcity. It's exhilarating. It's also emotional. Prices can move 10 a day up or down. If you're going to put a slice of your first 100 here, write these rules on a sticky note and put it on your screen. Only what you can emotionally afford to see drop by half. No leverage, dollar cost average if you participate. Protect your keys. Learn before you leap. What's the bull case for crypto? For Bitcoin, Its digital hardness a cap on supply and a growing narrative as a store of value over long horizons. For Ethereum, it's a platform for decentralized applications and financial primitives. For the rest, it's a spectrum from promising to speculative. What's the bear case? Regulatory surprises, technology risk, adoption cycles, and the simple fact that narratives can outrun reality for long stretches. Crypto can be part of a modern portfolio. It should not be the whole thing when your total capital is 1 or 2 paychecks deep. Treat it like the hot sauce. A dash can transform the meal. A bottle ruins your dinner. Now, the last stop on the risk spectrum is where math gently taps you on the shoulder and says, please don't. Lotteries and scratch cards are designed to be entertainment with negative expected value. The odds are theatrical. You are more likely to be struck by lightning than to hit the jackpot. People buy them because the dream is vivid and the cost is small, but your 100 is oxygen for your engine. Burning it for a story you'll tell for 5 minutes is not a plan. If you love games of chance, set aside a tiny, fun money bucket you truly can afford to lose and call it what it is, a ticket to a 2-minute dopamine hit. Your investment plan should not include hope as the primary driver. Hope is a magnificent fuel for effort. It is a terrible strategy for returns. Let's pause and do something most videos never do. Match the option to the person, because you are not a generic investor. You are a real human with a life. If you have zero buffer and high anxiety about sudden bills, your first 100 goes to the emergency fund. You will sleep better and make smarter choices immediately. If you have a small buffer and want a hand-soft builder, your first 100 goes to a broad index inside the best tax wrapper you can open in your country. Automate 10 a week if that's what you can do. If you're eager to learn by doing and willing to work for your return, take 50 for a flip in a niche you understand and 50 to your index. If you're fascinated by tech and can stay rational in a storm, take 10 to 20 to start a tiny crypto position as a multi-year experiment and send the rest to your builders. If you crave dividends and like the idea of properties without the plumbing, add a small REIT slice 20 or 30 to taste. Recognizing it will wiggle with interest rates. There is no single correct recipe. There is a correct order. Buffer before bravado, builder before bets, and learning on purpose before luck. Money that learns tends to multiply. Money that chases tends to disappear. And because I promised you a 30-day practice that changes your relationship with this first 100, here it is. Day 1. Open one account you don't already have that moves you forward. If you need a buffer, open the high-yield savings and nickname it Emergency Only. If you need a builder, open the brokerage and set up the index purchase. If you have both, write down your small crypto or REI to experiment and your rules. Day 2. Automate a deposit you won't miss. $5, $10, $20. If you can forget it, it's the right number. Day 3. Learn one thing for 15 minutes and write it down in your money journal. Not a binge. Just one lesson. What a dividend is, how an ETF works, what a private key means. Day 4. If you're flipping, pick and list one item. If you're not flipping, review your allocations and pat yourself on the back for showing up. Day 5. Read your sticky note rules out loud. Day 6. Touch nothing. Learn. Don't churn. Day 7. Check your emergency fund and smile when you see a balance that wasn't there before. Repeat that rhythm 3 more times. At the end of the month, you'll have done more than most people do all year. You'll also have built trust with yourself. Trust matters more than any ticker. When you trust that you'll keep your small promises, you can set bigger ones. That is the quiet hinge on which wealth swings. Let me make this even more tangible with 3-minute scenarios. If you are truly starting from scratch with no buffer, take the entire 100 to your emergency account. It's not glamorous. It is strategic. Set weekly auto deposits, maybe $5. Put a sticky note on your card that says, emergencies only. You're building a moat around your future. If you have a small buffer and want growth, take 70 for a broad market index fund via fractional shares, 20 for a red index slice, and 10 for a learning lab. Either a single stock you can explain in one paragraph or a tiny slice of Bitcoin or Ether. Write why you chose each. The exercise is as valuable as the allocation. If you're a builder who loves experiments, try 50 to your index, 20 to a red, 20 to your first flip, and 10 to a micro crypto position. Track the flip's profit. If it works, roll profits forward. If it doesn't, you just bought a class in pricing and your builder bucket still grew. A few timeless rules will keep you out of ditches. Never borrow to invest your first 100. That is not leverage. That is lighting a match in a dry forest. Avoid anything you don't understand that promises guaranteed high returns. In finance, the word guaranteed is a neon sign that says run. Do not confuse frequency with skill. Checking your balances 10 times a day does not make the number go up faster. In fact, it makes you easier to manipulate, create friction in the wrong direction, make it easy to save and hard to swipe. Move your automated deposit to the morning your paycheck arrives so you don't notice it leaving. Turn off push notifications that turn your brain into a panic button. Protect your attention like it's an asset, because it is. Now, if you're still with me, here's a quick gut check that millionaires use and beginners avoid. Write the downside first. Before you buy anything, ask, what could go wrong? What is my next step if it does? If the market dips right after you buy your index fund, will you stop contributions or continue? If your flip doesn't sell in a week, will you drop the price or unlist and hold? If crypto plummets 40 in a month, will you stick to your tiny allocation or chase? Pre-writing these answers removes the impulse to improvise under stress. People don't blow up because they picked the wrong asset. They blow up because they changed their plan in the middle of a storm. One last tension to resolve. You may be thinking, isn't 100 too small to matter? Only if you treat it like it doesn't matter. Money doesn't have feelings. You do. The habit built on your first 100 is the same habit that will steer your first 10,000. Tiny deposits become bigger ones automatically when your income rises because the pipes are already installed. You are not trying to get rich off this first bill. You are trying to become the kind of person who doesn't let money boss them around. So let's put it all together in a story you can remember. Picture 3 envelopes on your desk labeled Buffer, Builder, and Bets. Your first 100 walks in like a new employee on day 1. You look them in the eye and assign them a job. If you got no safety net, you hand them to Buffer and say, your job is to catch me when life throws a plate. If you have a net, you hand them to Builder and say, your job is to show up every week, buy the market, and keep your head down. If a small slice goes to Bets, you say, your job is to teach me through small wins and losses, not to entertain me or stress me out. Every payday, more little employees walk in. You point them to their envelopes. Months pass. One day you look up and realize you're running a department, not just shuffling bills around. That's how grown money feels. Why am I so stubborn about this order? Because I've watched bright people confuse lottery tickets with plans and wonder why they feel stuck. I've also watched average incomes paired with ruthless consistency build quiet, comfortable wealth. The difference was never IQ. It was sequence and patience. If you learn to love boring deposits, you earn the right to take interesting risks, not the other way around. A final nudge to your attention. Are you worse than millionaires? No. They simply ran more cycles, made more decisions, and this is the unglamorous part, stuck to simple habits for longer than was convenient. Your first 100 is your first cycle. Make it. If you haven't yet, pick where it goes before you close this video. Say it out loud. 50 to my index inside the wrapper, 30 to my buffer, 20 to my REIT slice, or 100 to my buffer, auto deposit on Fridays, or 70 to the index, 20 to a flip, 10 to crypto with a 2-year view. Put the plan in motion. Celebrate the click, not the number. The number will take care of itself if the clicks keep happening. You don't need a perfect strategy. You need a start that survives your own human moments. Protect first. Build second. Bet small and learn. Then repeat. That is how you turn 100 into something you can feel, not in one heroic leap, but in a series of tiny, unexciting, unstoppable steps. If you're still doubting, do this 1-minute exercise before you go. Write today's date, the words First 100 Plan, and 3 bullet sentences. Where it goes, why, and what you'll do when it wiggles. Seal it in your notes. In 30 days, read it. If you kept your promise, raise your deposit by $5 and smile. If you didn't, lower the friction, shrink the amount, move the automation to payday morning. Ask a friend to be your accountability partner. This is not a test you pass once. It's a practice you keep. One day, sooner than you think, you'll look back at this exact moment and laugh at how dramatic that 100 felt. You'll have a bigger buffer, a steady builder, and a few thoughtful bets that taught you more than any textbook could. And you'll quietly realize something most people never do. Money isn't the boss of you anymore. You gave it a job. It's been working for you ever since.